Hi there guys, good morning and welcome to Opening Bell with me, Stacy Pereira. I'm here to take you through all those news and cues you need to be watching out for. Of course, this can go on to impact your trading day, and we have quite an interesting setup if you have to look at the markets, trying to hold on to those levels quite hard, one would say, but buckling under some bit of pressure in a midday trade is what we've been noticing, but still managing to hold out to those crucial levels. Though, if you have to look at the broader sense of how India is performing compared to its peers, well, in terms of the inflows that we're getting from foreign fund flows, there we seem to be ranking quite high, and even the domestic buying has hit a 4-year high when it comes to the month of March. So, of course, we are seeing that bit of correction after that run-up rally that we've seen, but what holds here from here on is what we are going to be talking about. What direction are we looking at? If you have to look at the handover, that seems a bit muted, and the GIFT Nifty also indicating that kind of start, at least for today's trade. But before we get into all those details, let me take you quickly through all the other news that is making headlines. Now, if you see Wall Street, that one corrected for the third straight session, with tech stocks being the worst hit. The indices, however, remain on track to close the 5th consecutive month of gains. And stocks in the Asia-Pacific market also traded in the mixed range following that weak handover from Wall Street. The GIFT Nifty, though, meanwhile, is suggesting a muted start for the Indian equities. And crude prices have given up some of ground as investors are now assessing the impact of wars in Eastern Europe as well as West Asia. Brent currently is trading around that $86 a barrel. And India's current account deficit, that one narrows to just over $10 billion between October to December. Last year, merchandise trade deficit, though, expands marginally to just over $71 billion in the same period. Well, we have barely 11 minutes to open to figure out which direction that Nifty is going to go, whether we manage to hold on to those 22,000 levels. But it seems like if you have to go with the indicator of the GIFT Nifty, that one definitely showing some bit of pressure once again on Wall Street as well as Asia. All of those markets are trading under some bit of pressure. But let me also tell you a little bit about what's happening in the F&O space. Now, we are just on the penultimate day, tomorrow being the expiry for the March series altogether. So we have a couple of stocks that are in that ban list, whereas the NSE has gone on to retain sale in the F&O ban list for March 27, so won't be able to trade in the F&O segment in sale, but has gone on to remove Biocon, Tata Chemicals and Z Entertainment Enterprise, and these have been in that ban list for quite some time, so they come out just a day before F&O expiry. In terms of the fund flows, we did see foreign institutional buyers get a little jittery, where they bought only shares worth 10.13 crore rupees in yesterday's trade. This is the provisional data that NSE puts out, whereas DIIs are the ones that are really holding up and really pushing the markets. 5,024.36 crore rupees worth of stocks is what the DIIs saw buying on March 26. So that is pretty much the trade setup that we have. But what are the kind of stocks that are really making this difference to the market? Where are we seeing the pain points? In fact, we did see IT take a bit on the chin in the past few sessions. Banking stocks, those ones too have come under some bit of pressure. The Bank Nifty, of course, is looking to get to those 47,000 levels, but unfortunately hasn't managed to get to that yet. And you're seeing at least private banks, specifically yesterday, HDFC Bank was among those that also saw block trade, but was taking it on the chin in terms of, not really adding much to the benchmarks for that. Let's get going then and discuss some more stocks and sectors that we need to be putting in the spotlight today. And joining me for that is Rajesh Pala, the Senior Vice President of Research and Technical Derivatives at Axis Securities. Good morning, Rajesh. Always good to have you on the show. Well, this seems like a truncated week. We know that we are going to see lesser volumes. We're going to see slower trade, one would say, and in that range-bound volatile manner. Now that we are just a day before monthly expiry as well, what are the kind of volumes do you think is going to be much lower? And the levels that one needs to be looking at, if you have to look at just, the trade in the F&O space, what would you be suggesting?
Good morning, Stacy. So it was very volatile month. Though we have financial year closing, a monthly expiry, so everything is lined up, and it's a truncated week also. So still, yes, we believe the thin volume would be there because still the recovery which we have witnessed in last couple of trading session is still not sufficient. To get the comfort zone on the market as still Nifty is struggling to cross its major supply zone of 22,100, 22,200 zone. So that level needs to watch out closely in next couple of trading session. If Nifty manages to cross about 22,100, 22,200 level, 22,200 level, then possibly again buyers interest will come back on street, and then we can see again traction on the buying side, and then we can see furthermore broad-based buying action in the market. Till the time Nifty not crosses this level, it's going to be a range bound behavior for at least for index point of view. But some of the stocks where outperformance still there, where we can focus at this moment. So stock specific action can reward you in terms of profit in for next couple of trading session. Index is going to remain on a sideways behavior. Even on the data front also, if you look at the major call concentration for Nifty is placed at 22,100, 22,200 zone. So that is very challenging for the Nifty to cross in short period of time. On the downside, 21,900 is the major put-based concentration. So that may act as a support area for Nifty for next couple of trading session. To play this range bound behavior of Nifty, here we are suggesting to initiate short strangle strategy. So in this strategy, one can look to write 21,900 put option that was closed at around 40 rupees. And on the higher side, 22,100 call option, which was closed at around 90 rupees. So by doing this short strangle, you can, get an inflow of around 130 rupees as a premium. Keep your stop loss at 160, and once this premium shrink towards 60 or 50 rupees, you can look to book profits also. So a range bound behavior of Nifty can be played by initiating short strangle strategy. For Bank Nifty, 46,500 is very important level, though we have expiry for Bank Nifty today. So 46,500, if we slip below to that level, then possibly we may see further more follow-up selling, and then a possible lower level we can see towards 46,300. That's the major support area for Bank Nifty. If we breaks below 46,500, till 46,500 is intact, some chances of pullback towards 46,750, 46,800 could be there. But again, that's the major stiff resistance at this moment. So again, in the Bank Nifty also, we could see range bound behavior for short period of time.
Right. Rajesh, in fact, speaking about the banking space, now we've been seeing quite a bit of volatility when it comes to most of those players that comprise in that Bank Nifty index. So how should one be playing, just specific stocks within that index, if not the index as a whole? Because that's quite a range that we have been seeing the, Bank Nifty really move almost 900 points intraday, is those kind of swings that we've seen. So within these, what would be the components and what would be your picks for them?
So I think from Bank Nifty, the stock which we like is ICICI Bank from private player. That stock is almost trading near to its all-time high trajectory. And even if we look at the near-term structure since last couple of trading sessions, stock is trading in very narrow price range. So if at all ICICI Bank manages to cross about 1,095 level, then possibly we can see a rally towards 1120 to 1140. So that stock is looking promising at this moment from a Bank Nifty point of view. Another stock that we like is IndusInd Bank. Some recovery is taking place. This is the fourth day where we have seen higher high low formation for IndusInd Bank. In this process, again, stock managed to regain about 20-day as well as 50-day moving average. So if IndusInd Bank manages to hold above 1480, 85 kind of zone, then possible pullback can continue towards 1540, 1560 kind of zone. So from private player, I think one can look to buy ICICI Bank as well as IndusInd Bank. These two stocks can show upward momentum if at all Bank Nifty holds above 46,500. So
Right, so interesting. Your picks are ICICI Bank and Indices, and so is Nomura. They also have a consensus candidate when it comes to ICICI Bank. Well, they put out a note on banks, and Nomura says that they had gone over and met about 30 institutional investors in Hong Kong and Singapore, and they noticed that there was that heightened interest for SBI and PSU banking ideas specifically. The investors largely believe that HDFC Bank has pretty much bottomed out at this point, and they see a challenging road ahead for private banks amidst this tight liquidity. Though they do find a consensus favorite in ICICI Bank and as well as Kotak Mahindra Bank. In terms of their preference for value, they are looking at banks over NBFCs. This is the Nomura note that has come out on banks, and their top picks are SBI, ICICI Bank, Federal Bank, as well as Axis Bank. So that is the note that Nomura has put out on banks, but quite interesting to see the diversions that we get even in terms of how the stocks are really reacting when you see an SBI and the PSU banks compared to the private banks and what they're doing. Let's also get going and speak about the broader fundamental side of the picture. We do have the monetary policy that is coming up next week from 3rd to 5th April is when the RBI will be putting up. We've already seen and heard what the Fed has done and other central banks and what stance they've been taking and how much is going to change there ahead of the election. So let's get the fundamental side of the picture, and for that joining me is Daljit Singh Kohli. He's the head of research and strategy at Vasuki India Fund. Good morning, Daljit, and so good to have you on the show with us this morning. We were talking about banks and how they were the underperformers all of last year, but now we are seeing them at least participate in some way towards that rally that we saw of some kinds. But what would be your perspective when it comes to rate sensitives now that we're getting into perhaps another wait and watch mode for the RBI? But what would be your take, and how should one be playing the whole banking and financial space? Your mic is muted, sir. You'll have to, yeah.
Yeah, sorry. So very good morning. We are very positive on the banking sector as such. As far as the rates question you raised, I think we'll have to wait for some more time for any kind of easing on the rates. Right now, the overall macro is not in favor of reducing the rate immediately, mainly because we see that one, that international pressure, whatever Fed is not, unless Fed does, we will have to be, for all said and done, we will have to be followers of that. So because it has an impact on our currency, so we have to manage that very well. And in terms of times of elections, I don't think RBI is going to be bold enough to take any action which will kind of derail this stable currency kind of thing. So there's not too much of action on the rate side, but there is a lot more that can be done in terms of the sentiment, in terms of making people believe that we are on the right track. And numbers are showing that trade deficit data, etc., everything is in our favor. So I guess from the RBI side, we are not expecting any rate cuts as per such. And for the banking sector stocks, now as a strategist for fund, we are looking at is that there is a war for deposits.
Mr. Daljit, I'm just going to have to, you're going to have to hold that thought and we'll get back to it, because we'll just address market open there, and we are seeing on your screens, good to see that green. In fact, the Nifty just about trading 0.3% higher, but holding on to that 22,000 levels, and that's where we're seeing that pretty much a support coming in there for the benchmarks, at least Sensex as well in the positive this morning, seeing 0.2% higher. The Nifty Bank as well, about 100 odd points that it has gain in just opening bell. So that is a good positive. The mid cap and small cap, in fact, the broader indices have been the ones that have been outperforming at least the benchmark so far, even given that huge correction that it saw in the weeks prior to this. Both the mid and small cap did see huge cuts, and now they're perhaps going back to those levels. The small cap indices almost 0.5% of gain. Nifty IT is one sector also that saw a good bit of correction, one would say, at least dips that one could buy in. Nifty Pharma as well, lot of action happening in the pharma space, and we'll be talking about those stocks that are pretty much pushing that index higher. The Nifty FMCG index also, they're buckling under some bit of pressure. Yesterday, we did see most of those FMCG names also in that laggard list, from the Britannia to Nestle, all of them seeing some bit of pressure. Nifty Auto, we are at a month end, so normally we do see good traction when it comes to auto stocks because they do put out their data at the start of the month. So that could be, reason for the auto pack also seeing some bit of positive momentum. Nifty Metals too, almost close to 0.5% of gain this morning. So that one also holding out there. You have a good mix, one would say, except for the FMCG pack at this point. Pretty much most of the other sectoral indices are, at least opening up in the green, one would say. So that giving, and you can see that in the advanced decline as well. Those numbers there, the advance are almost 1,532 compared to just 401 in terms of the decline when it comes to the NSE. Now, the realty index is also something that's quite interesting to be tracking out, and almost close to 1% gain coming in there, just about short for the realty index. But let's look at the gainers and losers there. Who's really contributing? Of course, we have the names there up on your screen. Adani Ports, Apollo Hospital, BPCL among your top gainers, Bajaj Finance, Reliance Industries and Hindalco among your top gainers. So quite an interesting mix. We wouldn't say, one sector specifically that is adding to it, but those auto components also there, Eicher Motors, Maruti Suzuki as well as Adani Enterprise among your top gainers. Let's look at the laggards as well. Tata Consumer Products, Britannia, M&M in that laggard list. You also have UPL, Dr. Reddy's Lab as well as Nestle India, Sun Pharma, HDFC Bank and Wipro. So they're quite a good mix as well that you're seeing among the laggards, because there are a couple of banking names that are making it back to that list. HDFC Bank again seeing itself in that laggard list, but a couple of other auto names which are otherwise in your positives like M&M making it to the losers list this morning. So quite interesting. Let's talk about which are these sectors that are actually going to be aiding trade. We know it's a truncated week, and which is why you're going to see quite thin and muted volumes in that as such when it comes to trade. But what are these sectors that you could actually be cherry picking then and actually making good money out of this markets? Let me go back to Mr. Daljit and get his word. Sorry, we had to abruptly, ask you to wait up till this market open that we could address. But go on with what you were saying, and what could be these factors, or rather the triggers for this market at this point?
Yeah. So the two things that we have to keep monitoring for banking sector now is, one is this war for deposits. So how is this going to impact the margins? In our understanding, definitely there will be a pressure on margins for almost all the banks. But going by the past record and in the past history, we see that during this time when there is a dearth of deposits, PSU banks are always winner because people have more faith on them. There is a government backing, etc. So normally, and their reach is also to the far-flung areas. So normally, you will see that PSU banks perform well in a tight deposit scenario. And that is what is probably leading now also. Private sector banks normally are a little laggard in that. Second thing to watch out will be, till now, or for last 6-7 years, we have seen that BFSI sector has been growing only on the retail. Corporate sector growth has not come. Corporate lending has not picked up so well, mainly because capex was dried up. So now that with the post the elections, we expect that there will be probably some announcements from big corporates or a kind of capex cycle to restart. Now, this has been eluding for very, very long time. Many people have been expecting this for quite some time. It has not happened. But I think now that with the visibility of the new government for next 5 years, a good runway for growth for India, we could see some of that happening. And if that happens, then corporate lending will pick up. Then obviously the private sector banks are beneficiary. So basically what we are trying to say is that there is no question or there is not too much of dilemma whether you should be on PSU or on private. You can have a portfolio with both the things together, and both will likely to perform well in next 2 to 3 years. As of now, our portfolio is tilted, as a disclosure, is tilted towards PSU banks.
Right.
We have almost 3, 4 PSU banks. We have some large NBFCs and
Interesting.
mid-cap private banks.
Right. Interesting, because that's where people are actually seeing that, perhaps PSU does have some more in terms of the valuations that you could actually still look at. But let's also look at a couple of other stocks that will be a buzz. And I'm requesting both my guests to just stay on both so that we addressed the other stocks that one could be looking out for. Now, I'm talking about here CDSL, and this because Standard Chartered Bank is likely to sell its entire stake of 7.18% in CDSL for about $151 million. Now, remember, the Central Depository Services, or CDSL as we know it, which is a public shareholder, has Standard Chartered Bank, its corporate banking part, which holds some stake, is likely to sell that 7.18% stake, or close to 75 lakh equity shares. This through a block deal is what our sister network is picking up. And right now, the floor price for that block deal has been fixed at 1,672 per share, which pretty much represents a almost 6.3% discount compared to the last close that we saw yesterday. So that will be interesting to see how this really works out. But let me get back Rajesh and get his sense of, we're seeing a lot of activity when it comes to AMC and brokerage stocks as a whole. Of course, not CDSL aside, or our main exchanges aside. How are we looking at something like an Angel One? They've just put out a QIP as well. We just heard from Motilal Oswal yesterday, also looking to raise funds through the debentures route. A lot of action happening there, a lot of fundraising rather. So how should one be looking at AMC and brokerage stocks at this point?
So I think AMC stocks are looking more promising from that space. HDFC AMC is on our buying list. That stock has shown good traction since last couple of trading session, and looking at the near-term structure, stock managed to give breakout of its falling trend line, and stock now managed to hold about 20-day, 50-day moving average. That is also adding up the strength on the near-term structure. So we believe that HDFC AMC can show further more upside momentum from the near-term trading point of view. 38.70, 39.40 could be the possible target in near term basis. One can buy and accumulate this stock with stop loss of 37.60. As you talked about Angel One, stock is still in the corrective phase. We have seen since last couple of months, stock is witnessing some supply pressure. This is the third consecutive month where stock is forming lower high-low formation. That clearly shows some sustained supply pressure is taking place. Though long-term structure is still bullish for the stock, in this corrective move, now stock has shown some buying interest from its previous swing low, which was at around 2,400 kind of zone. So at this moment, if stock manages to cross about 2750, 2800 kind of zone, then we can see, for fresh buying interest may come back to this stock, and then we can see further higher level from 2800 kind of zone. So at this moment we believe some consolidation is likely to be there in Angel One. On the downside, 2600 is the important support area. On the higher side, 2750, 2800 are the key supply zone at this moment. From that space, one can look at BSC also. That is showing very good recoveries from its recent swing low. And looking at the overall structure for Bombay Stock Exchange, we believe that if it continues to hold about 22 30 level, then possible upside we could see towards 2500 to 2600 for BSC. So that stock is looking promising from this space. So HDFC AMC is our first choice, then second is BSC. These two stocks are looking promising.
Right, quite interesting. Let me in fact tell you more about that Angel One QIP that we were talking about. Well, the floor price for that is somewhere at 2,555 per share. This could be a discount of close to 7% if you have to compare it to yesterday's close, and this issue price will be determined on April 2nd. So you can get that exact price come April 2nd for this QIP that Angel One has launched. But let me go back to Mr. Daljit and ask him about pharma stocks, because that is something that has space rather has seen quite a bit of action. A lot of different companies coming up with M&As, a lot of regulations that are coming through in the positive way, that we're getting US FDA approvals for a couple of these names. We're seeing a lot of action in terms of even hospital stocks. In fact, there is some bit of M&A action in that sense, where Aster DM has gone on. One of its private equity players, that is Olympus Capital, has decided to sell its stake in the company. This also via a block deal. So a lot of action that we're seeing among these pharma stocks. So how should one be playing it? Should we just be going into the regular, the ones, the APIs or the exporters that have a better, they've shown better earnings growth as well? Or would you choose the diagnostic and the hospital play at this point? And what should one strategy be?
So as of now, our strategy is to look for stocks, a mix of stocks which have more exposure to US and regulated markets, as well as domestic formulation. So we have companies which have almost 50-50 to both these segments, or companies which have some 70-80% towards the regulated markets, 20-30% coming from domestic formulation. Both these segments are doing very well. In fact, as you mentioned yourself, that US FDA issues, which were a big overhang for this sector for almost 2-3 years, that has reduced a lot. Many of these companies which have got their approved plants or sites cleared from US FDA after 7-8 years. So those are the things which are helping. Secondly, the price erosion which we were seeing in base molecules in US, that has also stopped. The third big trigger for this segment is the biosimilars. Now we know that almost next 2-3 years, probably $130 billion worth of biosimilars will get off patented. So they lose their exclusivity, and that will open up a big market for players like most of the Indian players who are already working for these molecules for last 5-7 years. So there is a combination of these. We already, as a disclosure again, in our fund, we are holding 5-6 companies in pharma. Couple of them only exposed to US and regulated markets, 1 or 2 which are only exposed to India. And then there is a combination of all of these biosimilar companies, etc. There are diagnostic companies. Again, we've seen that after 3-4 years of price war and significant damage to their EBITDA margins, they have come now, they've settled down. So in fact, yesterday or a few days back, we heard that some of the large diagnostic players have started raising prices, some 5%, 10% here and there. So that means that this price war is probably coming to an end. And that again is a good sign for the sector. Within the diagnostic space, we have a company which is a differentiated model, which has B2G, which works with private partnership with the government. And that kind of a unique business model, where we know that for every government, this is healthcare is a very important subject, and there will be a lot of potential in that segment. So we are holding one of that company in our portfolio.
Right, interesting. So you could also look at that diagnostic and hospital space if you're looking at overall healthcare, that one to be driving up. But let me tell you more about that block deal that we're likely to hear of, and this Moneycontrol getting you this exclusive, where we are picking up that Olympus Capital Asia's investment is likely to sell almost 9.8% stake in Aster DM Healthcare, and this could happen via block deal anytime today. Remember, the company is looking, it already holds quite a big chunk, we could say, in this, which the block deal size could be anywhere close to $235 million, with a a floor price that could be set at close to 400 rupees per share. The PE already holds somewhere around 18.96% stake in this, so it will be looking out to almost half that stake by selling about 9.8% is what we're giving to understand. But let me get in Rajesh and ask him about insurance stocks, because that's something that we saw quite a buzz yesterday. Of course, there was positive news in terms of that surrender value that gave relief to these life insurance companies, but a couple of queries also coming in there for LIC specifically. But your take on how should one be playing insurance, and what would be your picks among that space?
Yeah, so buying interest was there in most of the insurance stock in last couple of week. From that space, ICICI Prudential is our preferred choice at this moment. Looking at overall structure, stock is moving in upsloping channel on the weekly chart. That clearly shows that there is a sustained buying action in this stock. So looking at the structure for ICICI Pru, we are bullish, and looking at the breakout on the near-term, short-term structure. If stocks holds above 580 zone, then possible target we could see towards 620 to 630 on a near-term to short-term perspective. So that stock is looking promising. Another stock is looking bullish is HDFC Life. That stock is also having the similar kind of structure. Stock is moving in upsloping channel on a daily chart. Stock is holding about to its 50-day, 100-day moving average. That is also adding up the strength on the stock for near-term to short-term perspective. So we expect that if it's holds above 610 level, then possible this upward momentum can continue, and we could see target towards 655 to 660 for HDFC Life. Looking at the LIC, Life Insurance Corporation, that stock has corrected significantly from its recent high. Since last couple of trading sessions, stock is attracting some buying interest from lower level. Stock is now holding around its 100-day moving average support area. So 875, 880 is the important level at this moment for this pullback. If it's a hold above 880 level for next couple of trading session, then this pullback can extend further. And on the near term basis, 945 to 960 could be the upside target we can see in LIC. So I think whole space is looking promising. Slow, steadily, all stocks are showing buying interest. So I think one can hold the position in insurance space, and going forward, we can see really to continue in all these stocks.
Right, interesting. One can hold their position in the insurance space because there could be further rallies, what Rajesh is saying. Do stay on with us, Rajesh. Let me address a couple of brokerage calls that have come in. Goldman Sachs has maintained its buy call on Reliance, and it has upped the target quite significantly to 3,400 at this point. They say the bull case really implies a 54% upside with a target of 4,495. They are seeing consolidated returns as an inflection point, and they're estimating that capex to fall sequentially. They do see a 17% EBITDA CAGR over FY24 to 27 estimates, and the returns could compound further with potential listing of their consumer business, is what Goldman Sachs has put out on Reliance Industries. Of course, there's a disclaimer here that we need to claim we are a subsidiary of Reliance Industries as well. But, let's talk about the large caps and that rotation that we've seen from people in their portfolios, where they're looking at mid cap and small caps now with, some bit of skepticism. Mr. Daljit, you have, you're pretty much looking at mid and small cap stocks in terms of your AIF, but what really, do you think this rotation is necessary, or do you think that there is more steam when it comes to that mid-cap, small-cap party?
See, first thing we have to understand is mid-cap, small-cap is a very wide term. There are stocks which are just 500 crore kind of market cap, and there are stocks with 20,000 crore of market cap. So you can't paint all of them with the same brush. So one has to be very clear what are you buying in your fund. There are some pockets within the mid cap, or we'll say broader markets. There are some pockets where the valuation has really gone out of the room, like railways or defense stocks, where the numbers will come after 2-3 years, but you're willing to buy them at any price today. So there one has to be cautious. But broader markets will always be stock specific market. You have to look for the opportunities where there is valuation comfort, where there are growth triggers. PE multiple may not have too much of relevance in those companies because for them earning itself will be a very big change. No? So if a small company is there, from for them, if next 2 years earnings are changing from 10 rupees to 30 rupees, the relevance of PE will automatically go away. So you have to be very careful about when we are saying valuations and in terms of what. As a whole overall perspective, yes, we are also changing slightly towards large cap. We are earlier we used to have only one or two stocks in our entire portfolio, so maybe 5% of the total portfolio was exposed to large cap. Now it is, I think, 20 to 25%. So mainly that has happened because PSU banks have come in. So PSU banks by nature are large cap. Metal stocks have come in, so they are by nature large caps. Some of the auto OEMs are large cap. So that's how the portfolio has changed its color. But it's not that by choice we are looking only for large cap or mid cap. We are looking for stock specific. Yes, portion for large cap is increasing because valuation comfort is there. Like we just now spoke about banking. So private banks, they're large cap, and most of them are available at very, very attractive valuation. So if somebody adds that in the portfolio, automatically weightage of large cap will go up. So
Right.
to that extent, yes, our portfolio tilt is also moving towards large cap.
Right. So there is that tilt. We are seeing it in terms of the outflows that we did see. Maybe different reason from, the regulators, SEBI, RBI, all of them talking about that froth that was building up in the broader indices. But before I let Rajesh go, I want him to give our viewers his top picks and recommendations that he has for this kind of trading week that we're seeing, and also for the week ahead. Any specific stocks that you're looking at, Rajesh?
So, Stacy, I think Tata Motor one can look to buy at this moment. Stock has shown very smart recovery in last couple of trading session. Looking at the overall structure, we believe that Tata Motor has potential again to move back to its all-time high trajectory, and near-term structure is clearly suggesting that now stock is holding about to its important moving averages. So 970 can be kept as a stop loss, and upside target we are projecting towards 1030 to 1040 for Tata Motor. Another stock that we like is Bharat Electronics. That stock has also shown recovery in this second half of this March series. Now stock is holding about 200 day moving 200 level. So looking at the recovery since last 4-5 trading session, this stock is looking promising, and we expect this momentum can extend further, and possible target we could see towards 212 to 215. So BEL is buy with stop loss of 197. And the third stock that we like is Container Corp. This stock after correction now showing recovery, and short covering action is visible in the stock. So looking at the short covering, we expect Container Corp can continue this pullback towards 920 to 930 kind of zone. So one can buy this stock with stop loss of 875.
Right. So interesting picks there. Tata Motors, BEL, and Container Corp. Rajesh's pick. Let me ask Mr. Kohli, what are the sectors that he thinks are the most promising getting into the new financial year? What would be your picks, at least sector-wise?
So at the top right now we have pharma and banking, BFSI. Within the banking, we maybe PSU banks. Then auto ancillaries we are looking at, and metals. These are the four sectors. There is one agrochemicals which we are preemptive buying, mainly with the view that probably one that this time the monsoon should be better. If La Nina happens, then we'll have good rainfalls, and this sector, agrochemical sector, has not performed for last 2-3 years. In fact, companies are beaten down like anything. Numbers are really bad. So if the in channel inventory and all those problems will get over if the rainfall comes up well, and preemptive that we are looking at some agrochemical stocks.
So Mr. Kohli's wild pick, or we would say a contra call at this point, would be in the agrochemical space. But seems like we're completely out of time on this edition of Opening Bell. Let me thank both Rajesh Palviya as well as Daljit Singh Kohli for joining us this morning and giving us his perspective on stocks and the markets and how to be treading ahead ahead. But with that, it's a wrap and goodbye from the entire team that puts this piece together. Thanks so much for watching. Do please post in your feedback and also keep sending us your queries because we try and get them answered in this show through our guests that join us every morning. But for all your other updates, stay tuned to moneycontrol.com and the Money Control app.